My apologies for that. I used the wrong intro about that, so I'll correct it in the editing. So, thank you all for joining today. For those of you who've never joined before, some housekeeping instructions. If you want to clap or laugh or find something brilliant, there are three emojis. Just press on that; the system will capture that. If you need to set or make a comment or a question, type it in the lower right-hand corner. And if you need to send private message to anyone in the group, just move your cursor over their name. The window will pop up. And if you think you're incredibly brilliant, just press on the microphone next to your name, and then I'll get a message to grab the mic. And as long as you're not a used car salesman, I'll probably let you join the panel. I'm really thrilled today because we have one of the most brilliant, upbeat, positive person who's mobilizing or trying to mobilize lots and lots of the $463 trillion there is in the wealth in the world to address climate. I'm not going to go into full details of who is Jacqueline from the Ende. We'll keep that a secret, and she can reveal her story. So, Jacqueline, thank you so much for coming. And also for those who are from a different planet and have never heard of you or carbon equity, I'd like you to just share your journey of how you got there. You know, your background and what led you. Why do you think that this is a potentially powerful solution for climate?
Yeah, cool. Well, thank you for having me, Robert, and thank you all for attending. My personal background, I spent half my career as an investor and half as a entrepreneur slash venture builder. So I started off my career formally in private equity with HAL Investments, a 12.5 billion euro fund in the Netherlands, buying and building companies. Prior to that, as a student, I founded my first company called The Kleine Consultant, which is now the largest student-run strategy consulting firm in the Netherlands, also with offices in London and Stockholm. So after almost 4 years in private equity, I felt I want to be on the other side of the table. I want to be building rather than being an investor and standing on the sidelines. So at that point, I joined Rocket Internet. Rocket Internet as a name might be less familiar, but they powered many global and especially European tech companies, including Zalando, HelloFresh, and Deliveroo. And they asked me to move to Southeast Asia, specifically to Manila in the Philippines, to build the online real estate platform of the Philippines, Southeast Asia. Which was called Moody. For me, that was sort of a real life MBA type experience. Grew the company from 1 to 100 people in 3 years and got to make a ton of mistakes as a first time CEO and company leader. After that, I became a CEO at a large fintech company, also in Southeast Asia. And then I accidentally became an investor again. I became a partner at a Dutch venture capital fund, investing in software as a service and marketplace solutions. And whilst I was there, in the past couple of years, climate change has started to become much more of a top of mind issue. It's always been an issue to me, but for me, it really started moving from, background awareness to top of mind, red hot alert. For me, the book, The Sixth Extinction, was really a pivotal point. I don't know if anybody read it, but it talks about the 5 major extinctions in the history of the planet, amongst others, the dinosaurs going extinct because of a meteor hitting the Earth. And in this book, the writer describes how in the past 300 years since the Industrial Revolution, temperature increases, but also loss of biodiversity have gone so incredibly fast on a scale and at a speed that the world has never seen. And for me, that helped me realize that really nothing else matters. I could be incredibly successful in my career, building companies and end my life with a huge bank account. But, if we don't have a livable planet, there's simply no point. So at that point, I wondered what I was doing as a venture capital investor, investing in software as a service and marketplace companies. I thought, what I'm really doing is making rich people much richer, but not really furthering the planet. So I decided to quit and refocus, spend the next 30 years of my career building companies that help solve climate change And my weapon of choice is capital. And why capital? I come from a background in capital, obviously private equity, venture capital, and fintech. And I strongly believe that ultimately money makes the world go round. And I'm not saying that's a good thing, but I am saying that it's an important reality, that ultimately that what receives funding grows, that what does not receive funding quietly dies. And so I'm very interested in the question, how do we move the needle on climate change with capital? And that's what we're trying to do with carbon equity.
Just to make it clear, carbon equity is not a retail platform for investing in direct deals. It's more like a fund-to-fund clearinghouse for other climate funds. Is that correct?
No, I would say the value proposition of carbon equity, that it allows you to invest alongside the world's top climate investors in the world's best climate solutions through funds. So the funds are a vehicle to deploy capital. And the reason why we do this is because if you are a private investor, whether you're a retail investor, a mass affluent investor, a high net worth investor, your options to deploy capital with impact are pretty limited. Take the view of a retail investor. What can you do with your money? The first thing that you maybe can do is invest in publicly listed stock markets, stocks. And let's say you buy a share of Tesla. What happens? What is the impact of you buying a share of Tesla? That impact is virtually none. You buy a company, you buy a stock from somebody else, so no money actually goes into the company. Plus, your additionality as an investor is virtually none. So investing in public stocks, it's very hard to have any kind of impact whatsoever. Shareholder activism might work. That's something that, that's a strategy that has proven to have some effect. But typically just buying or investing or divesting public stocks has very little impact. The second thing that you can do as a retail investor or as a mass affluent investor is to do angel investments or crowd equity. So through platforms such as AngelList or crowd equity platforms such as Seedrs or Crowdcube, you can invest in individual companies. Whereas that can have a lot of impact, investing in these early stage startups and scale-ups, here your money euro for euro goes into the company, so you can have a lot of impact. However, it is very risky because you're putting all of your eggs in a single basket, and you need to do the diligence, the research, the investment decision all by yourself. So the thesis of carbon equity is, one, you can have way more impact by investing in private markets rather than public markets. So carbon equity only does private equity investments, meaning venture capital, growth equity, and private equity. And our second thesis is, if you want to be investing in private markets, it makes a hell of a lot of sense to do that in the form of a fund. Why do ultra high net worth and professional investors invest in venture capital and private equity funds? Because they lean on professional management of these funds that do the investing work for you. And you get to diversify because you're not investing in a single company, but you're investing in a basket of companies. Unfortunately, it's virtually impossible even for high net worth individuals to invest in these funds, because typically the minimum to invest in such a fund is 5 million euros. So even if you had like 20 million euros, it would be a huge chunk, a huge commitment to invest 5 million euros in a single climate fund. So what carbon equity does is we democratize climate, venture capital, and private equity investing by bringing down that threshold. So the first step that we made was we brought down that threshold from 5 million to 100,000 euros. The second step that we launched just 3 weeks ago is we launched a Climate Investment Club. And through the Climate Investment Club, you can even invest from 10,000 euros. The vision there is that ultimately it should be possible for anybody with a pension, anybody with an inheritance, anybody with a savings plan for their children, anybody with a bonus from their company can invest in climate solutions through carbon equity in a sensible way. And finally, what do we do then on a daily basis? Carbon equity does three things. One, we curate fund opportunities. So we look at 800 global climate venture capital and private equity funds, and we select the top 5% most impactful funds based on a proprietary climate diligence framework. and the 5% most financially interesting funds. So first it needs to be impactful. Then we look at, is this a financially solid, a financially attractive investment? The second thing that we do is we provide access by lowering these investment minimums. The third thing that we allow for is diversification. Because you can invest with lower amounts, you can invest in not a single fund, but maybe in 10 funds. For a fund of funds, you invest in 200 climate technology companies through 8 underlying funds. So you have massive amount of diversification. And the fourth thing that we do is we bring it alive. So for us, it's not just about deploying capital, but really also making it really tangible how your money is making an impact. So through the app, you can see exactly what companies you're invested in, what they do, videos, education. We have tons of webinars. So we really want to take you on an active climate journey and how your capital is helping build the net zero future. That's what we seek to do, and that's our value proposition.
Okay. Do you invest in first-time funds or first-time funds as a team?
Yeah, that's a very good question. Yes, we do. Not often. So typically we like to see some track record and especially experience on behalf of the fund management team, because there are higher risks involved with investing in first-time managers. But yes, we do. So if we have sufficient confidence that this is an experienced team, if there are strong anchor investors, if there is strong, for example, domain expertise, then we will invest in first-time funds, such as, for example, 2150. It's a super cool urban tech sustainability fund. It's really awesome. They invest in all kinds of solutions to decarbonize the built environment. Think of Carbon Cure. This is a company that captures carbon from cement factories and then injects it back into the cement to fortify the cement. Well, this was a first-time fund, but they had partners who had worked with other funds and had a ton of investing experience. They had NREP, which was one of the largest Nordic developers, as a cornerstone investor. So they brought in a ton of network, and they had built up a nice early portfolio of very credible and high quality investments. So then we give them, well, not the benefit of the doubt, but then there's a reason to say, okay, we're definitely committing to also to this first-time fund. But it's a mix.
And what you say that you're looking for impactful fund managers. So what does
Yes.
that mean? How do I come across as an impactful fund manager to you?
Yeah, that's a super good question. This is one of the things I think we focus on most, which is one of our biggest points of differentiation is really the climate diligence and the quality of our climate diligence. The objective of our climate diligence process is to separate funds that are greenwashing, or they're putting a nice green label on it, or positioning themselves as climate, versus funds that are intrinsically end-to-end committed to realizing impact. The first thing that we obviously screen for are these funds really investing in decarbonization solutions. So again, big differentiator between carbon equity and other potential sort of investing opportunities. We're not investing in slightly better companies. We're investing in companies that really can deliver a material solution to decarbonizing the planet. But what we do is we have developed a proprietary climate diligence framework. It consists of 40 to 50 questions, where we assess every single step of the investing process to understand how is impact safeguarded within the fund. So we look at who's on the team, who's responsible for impact. What goals do you set at the level of the impact of the company, of the portfolio company? What impact goals do you set at the level of the portfolio? How do you decide on impact at the level of your investment committee? To what extent are the incentives of fund managers tied to actually realizing that impact? And when we look at the portfolio, what actual investment decisions have you made, and how do they line up? How do they stack up versus your impact mandate that's on paper? So we assess a fund head to toe based on how is impact realized and safeguarded within the mandate and the execution of this fund. And this is where we score funds on a scale of 1 to 5. Funds need to get a 3 to even progress in the next step of the process, which is the full or financial diligence. In the financial diligence, we look at who's the team, what's the track record, What's the expense structure of this fund? What are the key risks and how are they mitigated? But if you don't pass the impact threshold, we won't even go there. So impact, we're uncompromising when it comes to selecting funds based on their impact execution.
Okay. Well, let's go a bit deeper into that uncompromising quote that you made.
Mm.
Nearly all of the climate private equity funds don't invest any money at all in the cheapest, easiest way of addressing climate, which is basically soil restoration or blue carbon in the oceans or
Yes.
regenerative
Good
agriculture.
point.
None of them, zero.
Yes.
So
Yes.
you have
Yeah.
a fund of fund or a
Yeah.
vehicle to
Yeah.
invest, and you're not investing in the best solution. I don't know if you know Professor Ratan Lal. He's
I
a
don't.
world authority on soil science.
Yeah.
He said if you restore the health of the soil and the vegetation, you can sequester 355 gigatons or
Yeah.
155 parts per million. But
Yeah.
none of these PE funds are investing in that.
Yeah, that's a very fair observation. So here's
Not a
how we
good question, but a fair observation.
and a good question. so so this is typically what falls under the category of nature-based solutions. And
Okay.
nature-based solutions can be extremely powerful. One of the challenges is their business model, right?
Mhm.
So what carbon equity currently focuses on is purely technology. So this can be a zero carbon cement, it can be electrification of steel plants, it can be vertical farms, but it's all technology based. What we currently do not yet do is nature based solutions. We might do nature based solutions in the future. I hope we will. So ultimately, that's one of the massive climate solutions. Nature based solutions is one of the very powerful ways to solve climate change.
Mhm.
Um, but it will be a different kind of fund and a different kind of returns profile, right? So this is something that we do not yet do, and it's a different kind of fund that is investing in this type of solution, and at times it's also a different type of capital. So if you look at the range of funds that carbon equity backs, it goes from, let's say, philanthropic, catalytic to market-based return, right? So a
Mhm.
couple of funds that are purely market-based return, and they aspire to achieve a financial return which is equivalent to any other venture capital or private equity fund. And then we've got funds such as a great example is, I would say, the Just Climate Fund, which is
Mhm.
initiated by Al Gore. And what Just Climate did is they said, how do we design, if we want to have as much possible impact towards the 2030 goals, what should a fund look like? They reverse engineered what a fund should look like to have impact. And what they got to is they got to a 15 plus 5 year fund lifetime, which is way longer, which is double the average lifetime of a private equity fund.
Mhm.
They chose a blended finance structure because they said, where is the funding gap? Well, the funding gap is typically when you go from early stage lab innovation to commercial scale. Because typically, this is where you have first plant risk. You need to build a plant to scale up that innovation. And that requires a huge capital outlay, let's say 20, 30 million euros or dollars to build a plant. Too risky for the bank, too expensive for venture capital. So what Just Climate does is they have a blended finance approach where they can finance the asset with project finance, but also have equity in the company as a kicker on their return. So this is how they structure and help solve the funding gap by pricing the risks in an appropriate way. And the third thing that they did is they said, we're not going to have a traditional carry, a financial carry incentive. A carry is when you achieve a certain hurdle performance rate, let's say 8% per year, then typically the manager gets 20% of the excess profits. They said, we're not going to have that. We're only going to have an impact bonus. So we're going to be rewarded over the actual impact that we achieve, and we're only going to be rewarded for the actual impact that we achieve. Now, that is something that is like it achieved the highest impact rating of a fund we ever saw. So it's really a very, very cool fund, but it's not for everybody. People are also investing their pensions through carbon equity, right? People are investing their children's savings. So there's a certain amount of risk that you want to take with that. So the idea of carbon equity, it's a marketplace where you can invest in several different funds and you can choose funds on that spectrum from fully catalytic to more market rate return. We start with climate technology, might in the future do biodiversity, might in the future do nature-based solutions. And all of these types of investments will have a different return profile. And the return profile could even be, the return profile could be very low, because people say, I just want to have as much impact as possible. I don't care that there's no business model, as long as my money is powering the most impactful solutions. Well, that's a choice, and Carbon Equity wants to facilitate that choice.
So you offer a diversification of the portfolio. People could put a little bit in this, a little bit in that.
Yes. Correct. Yeah, so through Carbon Equity, you can either invest in a single fund or in a fund of funds. In a fund of funds, you obviously have more diversification. So through the current, we have one fund on our platform, which is called the Carbon Equity Decarbonization Fund, which is our climatetech fund of funds. You invest in 150 to 200 companies through 8 underlying funds. Or you can invest in a single fund because you say, well, I'm interested in agro-food, or I'm interested in circular economy, or I'm interested in investing in a growth fund. And then you choose a single fund just to have a certain accent in your portfolio. The lower our investment minimums, the more people can diversify. Because if you can invest in a fund of funds, let's say from 50,000 euros, and you can invest in a single fund from 10,000 euros, you can sort of start to build your own portfolio of all different fund investment opportunities through Carbon Equity.
And what what rate of return are you trying to achieve for your investors?
Yeah. Well, it depends a little bit on the type of funds that you're investing in. Let's say the fund of funds is highly diversified. So it is a slightly lower risk type investment product. By the way, sorry, that's hard to say. Venture capital and private equity are high risk investments. Let me say that first. And you should be careful to invest a large proportion of your assets, right? So on average, if you look at high net worth individuals, I think it's between 15 to 25% of their assets max in private equity, and not in a single private equity funds, but in a range of private equity funds. So high risk. But if you invest in private equity, the highest possible risk is a direct investment or an angel or crowd equity. Second highest risk is a single fund. Least risk in private equity investing is a fund of funds, because you simply diversify your risk more. The return profile of our current fund is 2 to 2.5 times net your money back over the lifetime of the fund, which is 10 to 13 years. So that should return a 10 to 15% target return on an annual basis. If you choose a catalytic fund, then that return profile might be a little bit lower, let's say 8 to 11%, for example. So that could be a slightly lower return type investment, because you're investing in project finance, or you're taking a little bit less market conform. You're choosing to have less market conform return on your investments. So, but typically for a diversified fund, 10 to 15%. For a single fund, it could be even higher. If you invest in a single venture capital or private equity fund through Carbon Equity, it might be between 15 to 25%, but more risk. And if you invest in like a more catalytic fund, it could be slightly lower than that.
You mentioned just climate, so that's part of Generation, or spun out of Generation.
Yeah.
So that's a tier 1 fund. How many of the funds, because you're doing also first-time funds, which are not tier 1 funds, and the ones that are really quite impactful are often not tier 1 funds. So I would imagine that the vast majority are not tier 1 funds that you're choosing.
Well, it depends on what you mean by tier 1 funds. If you mean the classical names in private equity, KKR has an impact fund, General Atlantic has an impact fund, Wellington, many.
In name. They have them in name.
Many in name, exactly. Yes. So you basically have a couple of different approaches to climate funds. You have the titans of industry that are launching their climate funds. Then you have people who have been investing in energy transition for the past 20 years, like Clean Energy Ventures. They were there from
Yeah.
2003 onwards, consistently investing in this theme. And the third category of funds are people who are new to the space, who are former entrepreneurs, former angel investors, and who are now starting to launch their first-time climate funds. We will, we look at the whole spectrum, right? But this is where we become uncompromising in impact. So we will not invest in a General Atlantic or a KKR or a CVC or whoever just because they have that label or just because they have tremendous historical returns. First, it goes through the climate impact assessment. So yes, we have turned down quite a lot of tier one funds because we were not sufficiently convinced on the quality of that impact that they're pursuing.
Okay. I would imagine that because you only started a while ago, you're not there. You haven't been doing this 10 years, so it's a
No, yeah,
relatively short period of time. So the assets that you've been able to accumulate that have not been taken out because of market
yeah,
changes is quite small.
yeah. It's 75 million. So
Okay.
it's not small. It's that's but yeah, we've been going for a little over a year. We're
Hmm.
almost 2 years, but our funds have launched over a little bit over 1 year. So 75 million in assets under management in 1 year. So our average commitments to funds range between 5 to 10 million, maybe 15 million at times.
Oh, really? So high. Good.
So we're not cornerstone investors just yet, and yet we get into all of the top funds. And the reason why we get into these top funds, at least funds that we consider top, right? So top in terms of impact, in terms of financial performance, we get there because people want to work with us because we're one of the most dedicated climate fund investing players, actually globally.
Okay. And you said there were 800 PE funds
Yeah,
in climate impact
correct.
that
Yes.
you found, and
That
of
we
that,
have found, yes, correct.
yeah.
Yeah, global venture capital and private. So it's a whole range. It's venture capital, it's growth equity, and it's private equity,
Hmm.
primarily concentrated in Europe and the US. But we're
Okay.
starting to look outside of Europe and the US. When you talk about impact and true impact, one of the places where we could have a ton of impact and which is totally under highlighted or under invested is emerging markets.
Yeah.
This is really where you can have I don't know, but maybe 3 to 10x the power of your money in terms of impact in emerging
Sure.
markets. So
Hmm.
again, this is a theme that currently we have not yet addressed. So far, it's been primarily US and Europe. But in the future, I definitely want to have an emerging markets fund. I want to have a emerging managers fund, which really invests in first time funds. So for carbon equity, it's about our impact is one in how much capital can we mobilize, and the ambition is to mobilize capital at the scale of billions.
Hmm.
Secondly, how many people can we mobilize? How many people can we get on board in deploying their capital to build a net zero future? And the third is additionality. We have more additionality investing in emerging market fund managers than investing in KKR impact, right? So also that for us is a dimension of impact, but it needs to be and impactful, and it needs to be a financially sensible investment.
Okay. And from the 800, how
Yeah.
many made the cut?
So far, 7.
Wow.
Yeah.
7 from the 800. Is that
Yes.
because the size of the fund is small, or just only 7 made it through?
Yeah. So, we've looked at dozens of funds, right? So there are dozens of funds that we have decided not to invest in or not yet. So the criteria are definitely super stringent. And for these funds, we deploy 5 to 10 million on average to each fund, right? So, it's on the one hand, it's fund size, and on the other hand, it's just the funnel of our selection criteria, as a result of which we have only selected these funds to date.
Okay. And because Thomas had a question here, I think he's confusing. You're not investing in direct deals, you're investing in funds that will invest
Yes.
in direct deals. But he did
Yeah.
have a question. How do you make sure you actually invest in the emergent the funds invest in emerging companies that actually have the exponential impact you want with an exponential problem like climate change?
Yeah, so in our diligence process, we really spend a lot of time in understanding what is the thesis of a fund, what is the expertise, let's say in agro-food or in built environments, what's their domain knowledge, what is their right to play, and how are they selecting companies. And typically a fund will have a impact framework where they say, these are the specific solutions that we're looking to solve, or this is how we quantify impact that is realized and forward looking. This is how we prospect what the potential impact of the company could be. And so we review how they select these companies and the quality with which they do that and the seriousness with which they do that. And by seriousness, I mean, does it have consequence? Do they look at the impact? Do they gauge the impact and then, not take that into account when deciding on what companies they're actually investing in at the level of an investment committee? Or do they, for example, tie their incentives? Do they, some funds, increasingly we see funds where 50% of the carry incentive is dependent on realizing the impact targets that you've set for the company. Then we're talking, right? Then you actually have a hard claim that is institutionalized within your governance structure, that you are actually committed to realizing this impact. So this is what I mean by quality of impact. How do you do things? But also, how do we make sure that you're going to stick to the plan and not opportunistically stray off plan and invest in companies that make a lot of financial sense, but from an impact perspective, don't add anything?
So, in your office or in the team that's doing the measurement, I guess you're doing the selection yourself and the due diligence yourself. You're not farming that out, correct?
No, yeah, that's exactly what we do. So half
So,
our team does that nonstop.
the team either gets incredibly furious when they see people claiming to be, or you laugh your heads off. Which one is it? From the,
You mean
from
when?
the 793 that didn't make the cut.
No, I mean, I think first of all, it's good that we have a lot of good choices, right? I mean, there are a lot of fantastic fund managers, a lot of people who are super intrinsically impact motivated, but we also just have a lot of choice, and we can be very choiceful because I mean, we have 75 million euros to allocate, and so we can only make maybe anywhere between 7 to 10 choices. So we're going to choose the best of the best of the best, right? So, but I think one thing that you can say about the whole climate investing landscape is that it's immature, right? It's still very much developing. So typically we're looking at first time, second time, third, maybe fourth time funds. We barely see a fund. We never see a fund that is, on their 10th fund. So the processes and the procedures within these funds, how we select for impact, how do we forecast impact, how do we measure impacts? Everybody's figuring it out. Everybody's inventing the wheel themselves, right? So also talking about impact measurement, everybody's measuring different metrics with a different measuring stick. So this is yet to mature. And as it matures, as we get more experience, we'll get towards a more common language as to how we prospect impact and how do we forecast impact, how do we measure impact, and then it becomes more comparable.
I love that you use the word immature. I would use fraud, but you like to use the word immature, and I prefer
Sure.
to be more like George Carlin and call them out.
Sure, you will
Tony,
see some fraud there, right? We definitely see some funds that use it as a marketing tool and now want to brand exactly the same thing that we were doing previously, and then put a sustainable label on it.
okay.
Sure, you will see that. Yeah, but
Tony,
yeah.
I'm sorry, go ahead.
Is it fraud? I would say it's opportunistic. It's opportunism. But the good thing is the customer, the investor is increasingly critical. And this is where we're going through an evolution, right? So, if you look at the whole ESG sustainability movement, it started like maybe 10, maybe 5 years ago. And then the first thing that people do is every put on a green jacket, every put a sustainable label on. And the customer was in awe. And the customer thought, this is awesome. ESG is impact, and I'm going to invest in my ESG portfolio, and this is how I'm going to help the world. And and then people open up their ESG portfolio and thought like, why am I investing in JP Morgan and Meta and Apple? And like, why is this in my ESG portfolio? And so people are waking up. And so the whole, we're going through like an awakening where people are starting to realize this is not just about the labeling. This is like, how am I really moving the needle? How am I actually having impact? And the customer is becoming critical, and that's a good thing.
No, I totally agree. I mean, having been in the space for 25 years and seeing the evolution or attempted revolution, that's also why we started the Better World Prize, which is some call it a People's Choice Award, some call it a civilized MMA cage fight from the ESG measurement people. What I can say, what's fascinating is that we have 40 companies presenting a very innovative ways of measuring, and we have
Cool.
100% success rate in not getting any major ESG rating company willing to present. Not one.
And
Anyway,
why is that?
because they know they don't have anything interesting. Imagine you are in the Philippines and you got two people there and you developed a really cool measurement system, right? You hardly have electricity, you're in the jungle, but you've developed this incredible measurement system and you win the prize. And a company like MSCI with hundreds of thousands of millions, billions that there loses. Can you imagine what what a
Mhm.
shitstorm that would be? And also, they don't want comparability; they never did. I want to
Yeah.
take a question from one of the superheroes of Southeast Asia, Tony Zola, who used to work at the Ma Falong Foundation in Thailand. He's asking, who does the climate impact assessment for you? Is there a methodology that you recommend? I mean, you said you have a proprietary
Yeah.
system. Do you
Yeah.
share that?
Yes, we can. Yeah. Happy to share that, Tony. So I'm happy to share our impact diligence framework with you. You can also find it through our website. If you look into one of the funds, you can see our impact framework. So happy to share.
Okay. Gaetan Japi, also he had worked in Myanmar as a private equity investor, wants to know, are you proposing direct co-investments in your fund's company portfolio?
Yeah, good question. Yeah, so we are starting on co-investments. So the first co-investment opportunities are starting to emerge from funds that we have previously invested in. We have interest amongst the higher net worth realm of our investor base to do co-investments. So we might be doing co-investments within our fund of fund structures. We might be setting up a separate co-investment fund, and we might even offer co-investments on a deal by deal basis to a the qualified section of our investor base in the future. So the answer is yes.
Great. Tanuja Prasad wanted to know, how do you ensure that the investor's culture does not lead the investee's culture away from the mission to profit?
Yeah, so that is very much that what we try to assess in our impact diligence. This is where we look at really the intentionality of the fund, and we measure this intentionality through execution, which is to what extent do they really tie themselves to realizing that impact. So I previously spoke about incentives. Is are their impact targets consequential? Does it hurt if they do not achieve them? And a second other very important measure, the way that we assess this, is by actually looking at what portfolio companies have they invested in and what was the impact rationale, and is that sufficient, or was this a rather opportunistic investment? So there have been funds where they have a wonderful impact framework on paper, they talk about it on the website, they talk about it in their sort of selection process framework. But if we look at what companies they've actually invested in, then we find them too opportunistic, right? For example, there are funds that are really investing in all kinds of enabling software solutions. Let's say, for example, cybersecurity, which you might argue is an important part for IoT, and IoT is very important in sensoring. And for example, sensoring is important in energy efficiency, etc. But for us, we really focus on funds and companies ultimately that are really have a direct contribution to decarbonization. So yeah, we look at execution, and are people putting their money where are they putting their money where their mouth is?
Okay. Amiron McConnell wanted to know from Luma Labs, what are the sweet spots climate technology to invest in, and what should fund managers look for when forming a climate fund?
Yeah, great question. Well, the first thing to say is that climate technology is pretty broad, right? So one might say that the entire economy is climate related, because anything that has a fossil fuel or that has GHG, greenhouse gas emissions, is something that needs to be innovated upon to lower those greenhouse gas emissions. So at Carbon Equity, we distinguish 6 key broad themes. The first is agro-food. How do we grow food, but also how do we package food? And how can we feed the world without carbon emissions? You've got mobility. You've got industry. Industry has 3 major sub-themes, which is cement, steel, and chemicals. We've got how do we store energy? How do we generate energy, and how do we store energy? We've got the built environment. How do we live and power our buildings? I think there's going to be a plus 1 billion air conditioners by 2050. How are we going to do that without the greenhouse gas emissions, without that energy consumption? And the 16th theme is carbon capture and storage. If you look at that whole spectrum of technologies, first of all, there are many different sub-technologies that are all trying to address the same problem. Think about the problem of cement. Cement is a huge problem. It's 8% of global emissions, which was 4 times the amount of global aviation in a year. And within for example, our climatetech fund of funds, there are at least 5-6 different companies all trying to address that same problem with a different solution. One company is replacing cement with wood. Another company is capturing carbon emissions from cement factories and then storing it in the cement. Another company uses biotechnology to create cement with bacteria. Another company is electrifying the furnaces to bake the cement. So many different solutions. If you look at a macro scale, there are certain areas that are overinvested in and other areas that are underinvested in. The areas that are most overinvested in is typically mobility. According to the PwC Climate Tech report last year, mobility received 80% of all funding, right? Whereas I think it's only responsible for like 14% of emissions. Mm-hmm. And the great areas of underinvestment, hence opportunity, lie within the built environment and also within the industry space, as carbon, as steel, cement, and chemicals. These are, of course, also the hard to decarbonize sectors, right? Which are more capital intensive, and so it's a higher hanging fruit versus, let's say, plant-based meat, or let's say electrification is one of the lower hanging fruits. So it's hard for a reason, but this is really where there is an opportunity space. And our second thesis is you really need to invest in a range of technologies. This is also why we think, it's so interesting to invest through a fund of funds, because you're not necessarily making a technology choice, but really betting on multiple horses. If I were to start a climate fund myself as a fund manager right now, one of the things that what I would myself do is really pick a thesis. What is a problem that I want to solve, and really make sure that you have a lot of domain knowledge. In that sense, climate investing differs from, let's say, software as a service investing, which is software as a service investing is much more about the business model, right? So you're investing in a certain business model and software scalability. Investing in climate markets often requires a lot more technical expertise to be good at something. So it helps to pick a domain that you really specialize on to build your network, your domain knowledge, your technical expertise within that domain, and then start investing in a niche universe of solutions, become very good, build a reputation in that, and from there on potentially expand. Just my own way to think about that.
You might want to look at, there's another issue that you mentioned cement, which there's lots of technology, but there's been a technology cement, geopolymer cement, which uses has no CO2 emissions, uses salt water, 3 times stronger, doesn't burn, uses waste material. And every single cement company has been blocking that technology for decades. So there is no fund, even if the fund was interested, because
Yeah.
I know one of the founders of that. He's in
Mm.
London, and I remember he told me BASF came to visit him, and they said, "We
Yeah.
love your cement because we have to build higher windmills, which means the foundation has to be stronger. Your cement is much stronger." So I said, "Great, I'll give you a license." No, 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 we're going to kill you in the courts. We're not going to let you develop your company at all. So here you have a technology that no fund
Yeah.
can even touch, which is, and it is a big emitter, and it's a pity because the technology, it's a Frenchman who developed the technology. Anyway, I'm going to take a question from Gaetan. He wants to know, what are the fund economics? So what are you charging? What is the management fee and carry?
Yeah. Good question. Well, maybe one thing to add to what you were just saying, Robert, ultimately in getting from innovation to scale, it's not only about how good is your technology, but also what is your go-to-market strategy.
Yeah.
How do you work with current industry players? How do you make sure that there's like a mutually beneficial business model? Because, if it's just going to kill the margins of incumbents, it's not going to fly. So how do you position yourself? And this is also where a fund can add value in, like, okay, you have a brilliant invention, but like, now how are you going to go to market, and how are you going to sell this thing, right? How are you going to scale that thing? So that's where a lot of support comes in from the funds. So a little bit on fund economics. Carbon equity is a fund of funds, and as a result, you have a double fee. That's always important to understand. Private equity is a relatively expensive investment asset, right? So a fund typically will charge a 2 and 20 percentage. So that means 2% management fee on an annual basis and a 20% carry. And typically, to achieve this carry, a fund needs to return a minimum hurdle. Uh, on average, hurdle rate is 8%.
Sorry
No
about
worries.
that. Let me just turn this off. Emergency phone call from Thailand. Sorry.
Okay. So typically that hurdle rate is 8% per year. Now, carbon equity charges on top of that an annual management fee, which varies depending on how much you invest and what fund you invest, typically between 40 basis points and 75 basis points. Might be a bit lower. So we have a professional solutions program, which is for family offices that invest in several million a year. Their fees can go down to maybe 30 basis points. And if you invest through the Climate Investment Club and you're investing 10,000 euros, and maybe the fees are 100 basis points. So it's a range, and it depends on how much, so how much you're investing and what fund you're investing. We do not have a carry incentive. So the reason for that is that we said a carry in a fund of funds is not a very reasonable. It increases the fee load too much. So our design objective in setting our fees is fairness. The design principle is it needs to be a good investment for you first and foremost. And carbon equity does not need to. We're venture backed. We don't need to stay afloat on a fund of funds with like 50 million euros, right? So low, very acceptable and very fair fees. That's the design principle. So annual assets under management between 40 and 75 basis points, and then a one-time 1% setup fee. That's the fee load. Yeah.
Tanucci wanted to know, how do you ensure that the best know-how is being used? The science is changing very fast.
Yeah. Yeah, that's a very good question. Well, we have our head of impact, Lisa Rubinstein. She comes from McKinsey. She has
No
spent her whole.
family.
Yes, exactly. Not family, right, Robert?
No, no, no.
Okay. Well, apparently impact runs in the Rubinstein family then.
Sort
um,
of.
so Lisa, she has dedicated her full career at McKinsey towards energy transition. She was one of the co-writers of the report, Getting Europe to Net Zero. And she does nothing else than studying the latest in impact science and having conversations with the world's best climate funds, consistently further our understanding of our impact framework. How do we assess impact, and how then do we measure impact? So that's one of the things that carbon equity really, I don't actually know of any other player that is as specialized in climate tech fund investing. So that's the only thing that we do, and hence we work 24/7 on being the very best in that very specific niche domain.
I had a question. I mean, I've known you a short time, and you're one of the few holograms from this virtual thing that I actually met face to face. You're very upbeat. You're very, you're not, calling out like I do. Boy, you guys are horrible. And you're always quite civilized, polite, but also quite upbeat when you're dealing with a very difficult situation. So either what medication or therapy or whatever, how do you maintain that positive, upbeat person and as well have a good sense of humor?
I think it's mushrooms. No, no, it's not. It's just no.
It's
No,
legal in the Netherlands.
no, honestly, I personally, I'm honestly very, very enthusiastic about what we're investing in. Like, I think it's really cool. Like all of these solutions from in when we in just in our recent portfolio, we have Form Energy. They're building massive iron air grid scale batteries for long duration energy storage. We've got Current Foods who are doing like plant-based sushi. The scale and the spectrum and the level of innovation in these companies is something that really inspires me, and I think is very cool, and it also gives me a lot of hope of yes, we can. I think there is reason for hope if you look at the speed of adoption and the speed of technological learning curves. Innovation happens very slowly, almost invisibly, and then suddenly. So I also really believe that we'll see multiple inflection points where you suddenly get a very large adoption or very fast adoption of these types of solutions. Actually, we now see it's triggered by the Ukraine war in Europe, where gas prices have gone the roof. Like everybody and your mother is trying to, make their house sustainable. So the demand for heat pumps or solar panels has just gone sky high. I mean, these inflection points will happen and these companies will be there when we're ready. So that makes me enthusiastic. And secondly, I feel we can mobilize people through hope. Like you and I talked previously a little bit about politics and whether I should be in politics or not. I feel, the bad news, we're aware of the bad news. The whole global population, we all know what's in the IPCC report. We all know that the news is not good, and yet it doesn't mobilize people. So my thesis is we need some sort of like a man on the moon type vision, like I feel like the moment that the US put a man on the moon, like was one of the more inspired, one of the most like proudest moments for Americans that they were putting a man on the moon, because it's almost impossible. I think we need some sort of like a man on the moon type vision for a net zero economy, and we need to mobilize people, sprint towards that moment. I feel people are not motivated by loss. And people are not motivated to retain the status quo. People want to win, want to gain something. So we need to paint a picture of what does that net zero future look like, and what are we running towards, and how is that better than what we have today? And that's where, how I feel maybe we can mobilize people to really take up arms and get running. So it's also my outlook on this.
Two wealth reports that came out, one from Credit Suisse and one from another organization. One is only focused on high net worth and claims there's $135 trillion in investable assets of the high net worth and ultra high net worth. And the other one is all of the wealth in the world is $463.6 trillion, according to Credit Suisse. So all of them are many, many times more than
Yes.
the GDP. So what
Yes.
is your big ambition? You have now 75 with average 5 million, so maybe 15 investors put money in there. Obviously, that's
Yeah.
not the end game. How many
No.
zeros do you want to accumulate for carbon equity?
Well, the goal in the next 5 years is to get to 1 billion, and the next 10 years, 10 billion. Now,
Okay.
if you look at what is the capital need in the world to help solve climate change, and what is the amount, what's the pool of available capital, our ambition is a drop in the ocean, right? I realize that. So carbon equity is not just about mobilizing capital. It's really about mobilizing people too. And this is where that message of hope is important. my hope is that when people get to become literal shareholders of the net zero economy and get as excited about all of these climate tech solutions, that are there, it helps them mobilize their network, their friends, their family to put their money behind the same goals, but maybe also to transition their careers in a more sustainable fashion. I get a ton of people investing through carbon equity and are like, I want to transition my career into the climate space. How do I do it? It's like the Tesla effect. When people buy a Tesla, they're statistically more inclined to have solar panels on their house. So, I hope there will be some sort of a knock-on effect of, and maybe a collective belief of, yes, we can. And that we can mobilize people as a result of that. So yes, and for me, ultimately, carbon equity, I want to spend the next 30 years of my life building companies and that help solve climate change with capital. For me, carbon equity is the first thing that I want to do. I would love in the future to build a solution in emerging markets. I think it's one of the more relevant problems to tackle, that we really start decarbonizing and industrializing in a sustainable way in the emerging markets. A lot of time in Southeast Asia. I would love to work there again in the future. So, we need multiple solutions and we need them all at once. So, yeah.
Okay, 2 final questions. How soon before you begin investing in nature-based solutions?
I'm going to think, I think it would be not coming year, maybe the year after.
Okay.
So my thesis, and so let's say in the next 24 to 36 months, my thesis there is first, step by step, first things first. So first be the very best we can in climate technology investing, and then we broaden to biodiversity, nature-based solutions, etc. So,
okay.
Yeah.
And what can the audience that's watching now live, and most of them will be watching the replay, what can they do to help you other than sending a $5 million check?
Yeah. Wire the money. That's the money. Bring me the money. We greatly appreciate your support and word of mouth. That's very valuable to us. So appreciate you signing up for our newsletter, telling your friends and network about us, sending us suggestions, sending us feedback for whoever is a carbon equity investor already or a carbon equity customer. Love to get your critical feedback on how we can be better. In general, open to get your suggestions and comments and questions. So spread the love. That would be
Fantastic. We'll send out the link for the replay and then some further contact information to the audiences. We have a hard stop in 1 minute because she has another meeting. I just want to take thank you so much for this. I just want to take a quick group selfie to prove that actually I was working today and not at the bar again. And so just wave to the camera. The camera will, collate everything, and then I'll send you a copy of the group selfie. I want to thank Jacqueline for a brilliant talk. I also want to thank our entire production crew for making this webinar possible. Sam, our producer, crypto genius, a ramen critic, and the person who called me during this episode. Ricky, my absolute better half with no filter. Xi Jinping, our head of transparency and integrity. Vladimir Putin, the military strategy and human relations advisor. Elon Musk, our humility coach. Kenai West, director of brand value destruction. And Marjorie Taylor Greene, our MacArthur Genius Award for discovering the Jewish space laser. So thank you all very, very much. I will run a short mixer after this. You're more than welcome to stay. Just sit put and let the system connect you with someone else. Jacqueline, thank you so much.
Thank you.
If there's anything we can do to help you, please, let us know. I really appreciate the work that you're doing and also the attitude that you have. Absolutely spectacular. Congratulations.
Thanks for the opportunity to speak with you. All right. Thank you,
My
guys.
pleasure. You stay well. Bye-bye. We're
LinkedIn.
going to go into the mixer. We'll probably do 3 or 4 rounds. And if you want to join, you're more than welcome.